Well, if there's a third party claim, especially for those, say, in the retail or franchise industry, what happens in that case is it's a question of if it happened on your property, even if it was caused by someone else or it's someone else's responsibility, believe me, you're going to be sued for it. They're going to try to hold you liable. And in liability insurance, so oftentimes it's not what someone does, it's what they fail to do. And that's especially true in retail and franchise industries because when you look at the risk, people always talk about trip and fall risks on those type of things. Well, those happen, and those are certainly things. But let's look at, quite frankly, some of the things that are more common today and what's happening, where there's actually violence on the site or God forbid, someone's actually seriously injured or even killed. And we've seen some examples of that. What's going to happen is that is going to spill over into the insurance of the franchisor and their master insurance plan and their risk management program. The issue then becomes how complete and how high were the limits that they required for their franchisees or for their tenants that were part of their landlord holding, shall we call it, for lack of a better term, the retailers, the owners of those businesses. Let me give you, this is a realistic example. One of mine is, I'm not sure if you've heard about these shadow kitchens, they call them, or ghost kitchens, where you go online and you order from a specific brand name, well-known fast food service. But the reality is, and it looks like it's local, but the reality is there's this conglomeration of all these different kitchens for different fast food services. The food is prepared there and then it's delivered to you anyway. You would never know that physically there was not a location where they not only fix the food, because they do, but where you can come in and sit down and eat it or have to drive by to pick it up because so many things nowadays are delivered. Well, in those kinds of things, then it, of course, expands the potential liabilities because then you've got the liability not only for the product, that is the food or the products that you're selling as a retailer, but also you've involved the auto exposure of them driving and transporting. And that's why they call these ghost kitchens. It's not that they have ghosts in them. It's that they appear to be XYZ. I'm going to say Taco Bell as an example, and that's not the one that's one of my clients. So I'll just use them as a theoretical example. But at any rate, for ones like that, that have these kitchens that prepare the food and then that deliver it. The question is what happens not only on their premises, but what happens in connection with their premises. So the key to remember here is it's not just what someone does, it's what they fail to do to prevent an issue. So for example, to get back to the retailers or the franchisors, if something happens at that location, they're always going to say, not what did you do? Because very seldom is it actually, quote unquote, the active liability of the person is either operating or the person that owns those retail sites or franchises, but rather they're going to ask, what did you fail to do? What could you have done that would have prevented the loss? And that's called passive liability. But the thing between passive and active liability, it really makes no difference. It's still liability. When you get to court, they don't say, oh, you were only passively liable. No, they say you were liable, whether it was passive liability or active liability. And therefore, once again, whenever we can get the overwhelming majority of that through the risk transfer provisions in the insurance requirements and then verify them, which our system does an amazing job of doing, not just of the requirements themselves, but also it automatically flags any prohibited or suspicious endorsements so that we can be sure to get those removed. Those things can actually, we think we have coverage because there's a policy there on this third party, but the reality is the policy is ineffective because one of these prohibited or what I call suspicious. In other words, it may limit depending upon what it is. And our system flags it so that we can see a copy of it and know for sure. When we see those type of things, it may be such that there's no coverage at all. And then all of that claim would fall upon us instead of shifting the first million, 2 million, 5 million, whatever it is that we require from them.